A monumental debt bubble keeps being expanded by the Federal Reserve in an attempt to maintain the inflation high enough not to let the financial system collapse. The constant liquidity injections are almost instantly absorbed by the financial markets, and the end consumer isn't really contemplated with the effects of such massive monetary reliefs. That's why experts in the field have been discussing that the Fed may implement a new policy in which it would deposit digital dollars directly to each American. In theory, it may sound as an inclusive and generous move, but of course there are lots of concerning implications behind their intentions, and the after effects are unlikely to change the status quo, but only to give it fresh face to an old problem and sweep it under the rug. For this reason, in today's video, we're going to expose what the Federal Reserve will be trying to accomplish with this new policy and why it can indicate the end of our privacy in monetary transactions. So please stay with us, and don't forget to give this video a thumbs up, subscribe to our channel, and share it with your friends. Over the past 10 years or so, the prevailing argument, despite the constant disruptions in the political scenery and the growing social and geopolitical turbulence, was that the market would keep climbing higher and the Fed would not cease to inject liquidity into the system. Another standard argument was that despite triggering unprecedented asset price inflation, prices as measured across the broader economy would stay subdued, but that was according to inconsistent CPI metric and considering stagnant worker wages. The Fed always planned to dramatically boost abroad inflation because there's no other way to get rid of the infinite trillions of excess debt that it has created. But the bank has been failing to execute this plan so far. The Fed's incapacity to accomplish its inflation target, which led the U.S. Central Bank to drastically reform its monetary philosophy last month and release flexible average inflation targeting, whereby the Fed will stimulate an increasing inflation without raising rates, has incited broad criticism from the economic sector. Although deflation had become a direct function of the Fed's unorthodox monetary policies, as the lower yields decline, the lower the susceptibility to spend. In a nutshell, the more the Fed tries to stimulate inflation, the more deflation and more saving it prompts as a consequence. In simple terms, after the implementation of QE and NIRP, which were launched to supposedly fix the situation, the shot backfired, and the Fed managed to ignite the burst of the biggest asset price bubble in history. However, now that the institution has accepted that its primary stimulus pathway has failed to give an impulse to the broader economy, the blame was redirected to how monetary policy was intermediated, particularly to the fashion the Fed produces excess reserves that end up at commercial banks instead of making its way down to the consumer level. In fact, after the events that followed the virus-induced shutdowns, the Fed has made attempts to short-circuit this process and aligned with the Treasury. It has introduced helicopter money, resulting in a direct transfer of funds to U.S. corporations via PPP loans and also to end consumers through the emergency $600 weekly unemployment benefits, which, however, are scheduled to expire. Except if Congress decides to renew it, but for the meantime, Democrats and Republicans are still battling over which fiscal stimulus will be applied next. Either way, the great misfortune is that even when the economy urgently needed a massive liquidity injection, the funds launched by the Fed and the Treasury were kept by the financial markets and never made their way to those who needed them the most, the end consumers. In that sense, as Main Street has been crawling to survive, Wall Street has been thriving with the money that was supposed to assure some dignity to Americans that were deeply affected by the current crisis. So, the most part of the huge debt that was created to put the United States out of a recession was destined to fund the wealthy in their quest to become even wealthier. And we're now not only deep into recession, as we're moving towards the greatest depression. For this purpose, we're going to examine a Bloomberg interview with two former Fed officials, Simon Potter, who headed the Federal Reserve Bank of New York's Markets Group and the Fed's Plunge Protection Team for years, and Julia Coronado, who worked as an economist for the Fed's Board of Governors for 8 years, now among innovators who are brainstorming solutions to what appears to be the most critical and difficult problem the Fed needs to assess: how to promptly bring money to people who need it most in times of crisis. The answer they gave for resolving that issue was astonishing: the creation of a monetary tool named by them as recession insurance bonds, which would draw on a part of the advances in digital payments, wiring them instantly to Americans. According to Coronado, Congress would have to grant the Federal Reserve another tool to provide support, for instance, a percent of GDP in a lump sum that would be partitioned equally and distributed to households during a recession. Such recession insurance bonds would act as a zero-coupon security, meaning that they would be households' contingent assets, which would essentially lie in wait. The ignition for enacting this move could be reaching the zero lower bound on interest rates, or as economist Claudia Sam has indicated, a 0.5 percentage point increase in the unemployment rate. Then, the Fed would have the cue to activate the securities and deposit the funds digitally in households' apps. Moreover, Potter stated that it took Congress too long to get money to people, and it's too clunky. We need a separate infrastructure. The Fed could buy the bonds quickly without going to the private market. On March 15th, they could have said interest rates are now at zero, we're activating X amount of the bonds, and we'll be tracking the unemployment rate. If it increases above this level, we'll buy more. The bonds will be on the asset side of the Fed's balance sheet. The digital dollars in people's accounts will be on the liability side. In substance, the Fed has plans to create a hybrid digital legal tender which differs from reserves that are stuck within the financial system. In that way, it could make direct deposits into U.S. consumer accounts. How is that different from the previous forms of helicopter money? Essentially, it isn't. Apart from the consideration that it would have direct access to consumers' information regarding transactions and any other monetary proceedings, nothing major, right? Furthermore, Loretta Mester, Cleveland Fed president, has publicly stated in the Chicago Payment Symposium in a section titled Central Bank Digital Currencies that the experience with the current health crisis-related emergency payments has, quote, brought forward an idea that was already gaining increased attention at central banks around the world, that is, Central Bank Digital Currency, or CBDC, unquote. And after the unexpected reveal, she goes on explaining that the legislation has proposed that each American have an account at the Fed in which digital dollars could be deposited as liabilities of the Federal Reserve banks, which could be used for emergency payments. The boldness, to say the least, of their proposal doesn't end there. By launching in digital cash, the institution would manage to find a way to eliminate the anonymous physical currency in its entirety, and then be able to track every single banknote that they've created, knowing the destination of every transaction ever made during the whole time it was in action. And at some point, the Fed could not only exterminate the digital currency when it becomes convenient, as it could practically disintermediate commercial banks because it would concede loans to U.S. consumers and also deposit funds into their accounts directly. That is to say, they would have the power to make the whole traditional banking system obsolete. So here we quote Loretta Mester's detailing of the program's functioning, published on the Cleveland Fed website, which explains that the proposal would create a new payments instrument, digital cash, which would be just like the physical currency issued by central banks today, but in a digital form, and potentially without the anonymity of physical currency, admitting they can crack the public's privacy data as they please. She continues outlining that, depending on how these currencies are designed, central banks could support them without the need for commercial bank involvement via direct issuance into the end user's digital wallets, combined with central bank facilitated transfer and redemption services, also acknowledging that it has the potential to separate itself from the current banking system and possibly crash its entire operation if it ever becomes fitting to their goals. Mester confirms that the implications of the plan are yet to be assessed by the bank, saying that the demand for and use of such instruments need further consideration in order to evaluate whether such a central bank digital currency would allow for quicker and more ubiquitous payments in times of emergency and more generally. In addition, a range of potential risks and policy issues surrounding central bank digital currency need to be better understood and the costs and benefits evaluated. In addition, the Cleveland Fed president discloses that several other units of the Fed are already putting the proposal into test, completing that the Federal Reserve has been researching issues raised by central bank digital currency for some time. The Board of Governors has a technology lab that's been building and testing a range of distributed ledger platforms to understand their potential benefits and trade-offs. Staff members from several reserve banks, including Cleveland Fed software developers, are contributing to this effort. The Federal Reserve Bank of Boston is also engaged in a multi-year effort working with the Massachusetts Institute of Technology to experiment with technologies that could be used for a central bank digital currency. The Federal Reserve Bank of New York has established an innovation center in partnership with the Bank for International Settlements to identify and develop in-depth insights into critical trends and financial technology of relevance to central banks. In conclusion, after presenting how the proposal allegedly would work, Mester highlights that it is still in the trial phase and it would probably require acceptance from higher grounds before being implemented, also declaring that the entailments of the plan weren't considered just yet, stating that such experimentation is an important ingredient in assessing the benefits and costs of a central bank digital currency, but does not signal any decision by the Federal Reserve to adopt such a currency. Issues raised by central bank digital currency related to financial stability, market structure, security, privacy, and monetary policy all need to be better understood. With all the evidence on the table, it's possible to understand that the strategy of depositing digital dollars to all Americans gives the Fed powers that were once exclusive to Congress, meaning that they would be able to concede fiscal stimulus at its will. Therefore, it will possibly boost a spectacular reflationary spike, since it is the lower income segments of American society that are the marginal price setters for economic goods and services. The bank will have the perfect excuse to constantly keep the inflation high while the American standard of living crumbles to the benefit of a small group of asset holders. To avoid being swallowed up by the huge federal debt, as Zero Hedge cleverly pointed out, the Fed is now finalizing the last steps of a process that revolutionizes the entire fiat monetary system, launching digital dollars, which effectively remove commercial banks as financial intermediaries, as they'll allow the Fed itself to make direct deposits into Americans' digital wallets. In the process, also making Congress and the entire legislative branch redundant, as a handful of technocrats quietly take over the United States. So don't be misled by thinking their money will come without consequences. because this proposal will likely end the monetary freedom of the whole population while it acts as a new surveillance system.